Kenna French, Vast Voice. Kenna French, that is vastsolutionsgroup.com. Vast Voice is our media arm for vastsolutionsgroup.com. Today we're talking about what to do for self-employed types, meaning with no employees, but they want to put away some money for retirement and potentially even get the lovely tax deduction. I'm going to go over just a few of the plans, but these are worth listening if you want to lower your taxes and put away some money for retirement. Let's go ahead and get started. Simplified employee pension plan. You can contribute as much as 25% of your net earnings from self-employment. By the way, not including your contributions for yourself. For 2020, that's $57,000. That's $57,000. Now, for every dollar, as an example, that goes into your tax, goes into type of a qualified plan that's pre-tax. Let's say your tax bracket is, let's make a guess, 25%. How much do you save on every dollar? 25 cents. You got it. You don't have to give that 25 cents to Uncle Sam. Instead, you put it right in the plan. Get a deduction, save some money. When you pull it out, that's when you pay the taxes, which, by the way, is the exact reverse for a Roth IRA or a Roth 401k. Anyway, establishing the plan. Usually it's pretty simple for simplified employee pensions, or SEPs as they're called. Usually it's one page. It's typically you're completing what's called Form 5305 SEP, or Simplified Employee Pension, which also comes with the Individual Retirement Account Contribution Agreement. Usually you can find those in PDF pretty much anywhere. And it's an IRS-approved prototype SEP plan. It's offered by many mutual funds, banks, and other financial institutions, even plan administration companies, etc. Now, if you open a SEP IRA through a bank or a financial institution, one would also find that same document, the 5305, etc., etc. Now, for you to set up a plan, you have to set it up in the plan, and you can do it as late as when you do your taxes plus extension. So as an example, here we are, let's just say we're in May of 2020, and you want to affect your tax for 2019. As long as you haven't done your taxes, you could still set up a SEP plan and affect your taxes for 2019. Now, does that make sense to you all out there? So if you are having a tax liability, plus you want to put away some money for retirement, and you have not done your taxes, go ahead, look into a SEP. That might make sense. Now, what about a 401k plan? Let's go ahead and start talking about item number 2, 401k plan. You can make an annual salary deferral for 2020 up to $19,500. Plus, by the way, an additional $6,500 again for 2020 if you're 50 or older on a pre-tax basis, or as I mentioned before, you can do a designated Roth contribution or a Roth 401k. Therefore, on the Roth 401k, you pay your taxes now, but it grows tax-free. By the way, so let's talk about some of the contributions. You can contribute an additional 25% of your net earnings from self-employment for a total contribution of $57,000 for 2020, by the way, including your salary deferral portion of the 401k. You can tailor your plan to allow access to the account balance through loans and what's called a hardship withdrawal. We won't get into those specifics here right now. Now, a one-person participant 401k plan called sometimes a solo 401k, Uni-K. There's a number of different names, but whatever the name, it's generally the same as 401k plan. It's usually because there are no employees other than a spouse or business partners. So it's exempt from what's called discrimination testing, so you don't have to worry about including anyone else because you don't have any workers who are participants, so you don't have to worry about passing the IRS and Department of Labor tests. Now, number 3, the number 3 way that you can save some money as the employer, though you have no employees, so you're both the employer and employee. It's called a simple IRA. It's also called Savings Incentive Match Plan for employees. You can put away all of your net earnings from employment in the plan up to $13,500 for 2020, by the way, plus an additional $3,000 if you're 50 and older, plus either a 2% fixed contribution or a 3% matching contribution. Now, establishing the plan, let's go over some of the specifics. You have to remember that form that I mentioned before, 5305, right? Remember I mentioned that one form? Well, you have to do it here too. But here it's called Form 5305 Simple, or the full name, Savings Incentive Match Plan for Employees of Small Employers, or Simple Plan. Also, for the Simple Plan, you have to fill out a Form 5304 Simple. So that's called the Savings Incentive Match Plan for Employees of Small Employers, but not for use with designated financial institution. Now, an IRS-approved prototype, or a simple IRA plan, is offered by many mutual funds, banks, and financial institutions. Now, number two, if you're talking about, again, a simple plan, you have to open a simple IRA through the institution. You have to set it up by January 1st through October 1st. If you've become self-employed after October 1, you can set up a simple plan for the plan year as soon as it's administratively feasible after your business starts. That's worth noting. Now, let's talk about a couple other defined contribution plans. Thing called a profit sharing plan. It allows you to decide how much to contribute on an annual basis. Now, it's up to 25% of compensation, which would not include contributions for yourself, by the way, or $57,000. That would be the maximum for 2020. Now, something seldom used is what's called, again, a defined contribution plan. It's called the money purchase plan. It requires you to contribute a fixed percentage of your income every year up to 25% of compensation, which does not include contributions for yourself, and it's according to a specific formula stated in the plan. Those are pretty rare nowadays. Finally, a defined benefit plan. That's what we do a lot of. We consider ourselves experts in the field for the micro entrepreneur market. A traditional pension plan with a stated annual benefit, you'll receive a retirement date down the road. It's usually based on a salary, years of service, age, etc. Also, it's a benefit that can be based on a cash balance formula in a hypothetical individual account. So it's called a cash balance plan. It's a type of defined benefit plan. Now, the maximum annual benefit can be up to $230,000 for 2020, that is. Now, there's some specifics that are worth knowing about when it comes to maximum contributions, but we can get into that maybe in another podcast, another Vast Voice. Contributions are calculated by an actuary based on the benefit you set and other factors. So, your age, expected rate of return, your salary, number of employees, et cetera, et cetera. But if you have no employees, as we've stated, this is the circumstance here, that is not a consideration, by the way. Really, no other annual contribution limit does apply. Now let's talk about really the last thing. Seldom seen, but still sometimes it is in the marketplace, and it's at least worth noting. It's called a KEOGH. KEOGH plan. So KEO plan. Retirement plans, it's really for self-employed people. It used to be called a KEO after the law that was first allowed unincorporated businesses to sponsor retirement plans. Now, since the law no longer distinguishes between corporate and other plan sponsors, it's not really used anymore. So, if you're looking for any specifics about these types of plans, please reach out. We can help you. VastSolutionsGroup.com, www.vastsolutionsgroup.com, or give us a call at 888-808-8278. We'd be happy to help you. Hopefully this audio has been of some value, and if so, please pass it on. Please tell your friends about it. We're here to help the entrepreneur. We understand the entrepreneur's plight. Once again, VastSolutionsGroup.com. We do tax, finance, and AI for the entrepreneur.